China reopening is really a very powerful tailwind. And on the growth side, we would express it through Chinese companies that benefit from this, including Asian companies. So in the case of China, we like the internet platforms, e-commerce, cloud computing plays. They have gone up like 70% from the lows in October 2022, but we're still a long way from the highs. We think that will be a structural tailwind, or at least for this year. So that is on the growth side of our portfolio construct.
Is it relatively safe to venture back into the real estate developers, or is that a no-go area given the risks there still, and given the structural issues in the real estate markets in China?
Yeah, I think that there are better risk-reward in global credit. And like I said earlier, the investment credit space is where you find pretty good safety, liquidity, and yield. So don't need to be, going into the Chinese property sector, which, we are still waiting for the dust kind of settle, in terms of the policy and, some of the developments there in China.
Wei Fook, I know you're CIO and you're more used to dealing with real money accounts and institutions, et cetera, but I just want to get your take on a phenomenon that's been happening for coming to a year now, about 9-10 months right now, at the retail level, and that is for DBS, your bank, for all the big three banks in Singapore, for OCBC, UOB, et cetera, there have been queues, lines around the block. And these are mom and pop account holders and investors, aunties and uncles, et cetera. And they've been trying to get in on the T-bill bandwagon. A year ago, nobody knew what a T-bill was. Now suddenly everybody wants to buy them, including taking money out from their pension fund, which is the Central Provident Fund, and investing in T-bills simply because the yields have been so almost spectacularly high. My question to you is that window closing?
As long as the Fed is not going to cut rates, I think the window is still open. The Treasury bills at 4+% is truly very attractive if you compare that with the history of the last 10 years. But the way we would advocate is for customers to, yes, buy into Treasury bills, which is the cash equivalent, and as well as some bond funds, because after all, if interest rates start to kind of decline, when you roll over your Treasury bills, when they mature, you may not get your 4+% anymore. So good to lock in some longer dated bonds at about 5% or more. And that's how we would like to advocate for customers to kind of construct their overall portfolio.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.